Hi there, I'm Edward Galstian, founder of Egg Capital, and welcome back to the channel. What if you could retire and never worry about running out of money? Imagine receiving a paycheck every month, but instead of working for it, your investments pay you. That's the power of dividends. But how much do you actually need to retire comfortably from dividend income? Let's break it down. First, let's start with a strategy you might have heard of, the 4% rule. It's one of the most popular guidelines for retirement budgeting, and here's how it works. In your first year of retirement, you withdraw 4% of your total portfolio balance. Each year after that, you withdraw the same amount adjusted for inflation. This approach aims to make your money last for at least 30 years. For example, if you retire with a $1 million portfolio, you'd withdraw $40,000 in year 1. The next year, if inflation is 3%, you'd increase your withdrawal to $41,200 and so on. The 4% rule assumes your portfolio consists of a mix of stocks and bonds, historically growing by around 7 to 8% annually before inflation. With a withdrawal rate of 4%, your investments should continue growing even as you withdraw, preserving your balance over time. But here's the catch. Markets don't deliver steady returns every year. If there's a market crash early in your retirement, your portfolio might shrink faster than expected. And if you're retiring early, say in your 40s or 50s, the 4% rule may not cover the extra decades. That's where dividend investing can really shine. With dividends, you're not selling your assets to generate income. Instead, you're living off the cash flows generated by your investments. And if you focus on dividend growth stocks, your income isn't static, it grows over time. Now let's dive into how that works. To calculate how much you need, let's reverse engineer the process. Suppose you want $40,000 per year in retirement income. If your dividend portfolio yields 4% annually, you'd need $1 million. If you would like $100,000 per year in retirement income and your dividend portfolio yields 2.5% annually, you'd need $4 million. Simple, right? But what if you could make even more through dividend growth? Here's where dividend growth stocks become exciting. Many companies increase their dividend payouts yearly, meaning your income rises over time, usually beating inflation. Take Coca-Cola. It has increased its dividend for 60 plus years. If you own dividend growth stocks like this, your income grows, giving you a built-in raise every year. This means you don't need to save as much as with the traditional 4% rule, because your income isn't static, it grows. Dividend Aristocrats and Dividend Kings are elite groups of companies renowned for their consistent dividend growth. Dividend Aristocrats are S&P 500 companies that have increased their dividends for at least 25 consecutive years. Dividend Kings have an even more impressive track record, with 50 or more consecutive years of dividend increases. Investing in these companies can be great for retirees relying on dividend income, as their consistent dividend growth helps combat inflation and increases purchasing power over time. An example of a dividend king is Abbott Laboratories. Abbott has increased its dividend for 53 consecutive years. Over the last decade, the dividend has grown by 128.6%, which is a compounded annual growth rate of 9.6%. Another example is Target, which has increased its dividend for 53 consecutive years as well. Over the last decade, the dividend has grown by 105%, averaging an annual growth rate of approximately 8.3%. An example of a dividend aristocrat is automatic data processing. ADP has a 49-year streak of dividend increases, and over the last decade, the dividend has grown by 179%, which is a compounded annual growth rate of 12.1%. These examples illustrate the potential for dividend growth among dividend kings and aristocrats. While historical performance doesn't guarantee future results, companies with a long history of dividend growth often have a resilient business model and a commitment to returning value to shareholders. Incorporating such companies into a dividend portfolio can provide a growing income stream, enhancing the sustainability of a retirement plan. A reliable dividend portfolio is often built upon companies that provide the following: a strong history of increasing dividends, a sustainable payout ratio below 60% is ideal, a solid business model that can survive recessions. Sectors like consumer staples, healthcare, and utilities often have great dividend stocks. So how much money is needed to retire from dividend income? The simple answer is the desired annual income divided by the portfolio yield. But the real magic happens with dividend growth, which grows income over time. If you found this video helpful, please like and subscribe for more investment content. And let me know in the comments, how much would you need to retire from dividends? Thank you for watching and see you next time.